It's Rob McGregor. It's June the 25th. I'm recording this from Camoli in Italy on the Italian Riviera. Got a week and a half before I'm back in the country on the 5th of July. And yeah, it's been interesting watching the world. There's so much happening back in Australia around tax changes and the deal making and everything else. I'm going to unpack some of those as well as talk about what's happening in the economy and the markets. As always, general advice warning for those of you that are not clients of McGregor Wealth Management. You shouldn't act on anything you see in this without taking advice for yourself. We're going to cover all the latest news. Let's go in with interest rates, the war, all the usual stuff. And I'm going to look at what that's meant for returns, for what's happening in the key markets. Talk about inflation, still one of the hottest topics. Look at the impact that along with legislation changes and proposed changes is having on the market, and keep it all in perspective. So let's jump in. And in terms of the news highlights, not a lot of movements. Cash rates staying the same, but yeah, I've got in there the Iran war is over, or is it? But here's the deal. The markets are looking past it anyway. If you look down this chart at the bottom, this is the Brent crude oil price, and you can see that massive spike up from pre-war levels of about 70-ish. Up to 120 almost, and over the last few months it's dropped down. So the market is effectively saying, yep, we think this is done. We think trade might start to flow through the Hormuz channel. That's going to lead to the oil shortages getting past, and that's going to, therefore we can start to discount the market. Interest rate bonds, 10-year government bonds, you can see in Australia they've dropped back to about 4.78%. We'll have a look in the US, but they've also dropped back. So they're starting to look through it as well. And certainly the share market has been performing as if there is no impact from the war. What it has left is an inflation hangover. So in Australia, we've got inflation at about 4%, down from about 4.2, 4.6. That's the headline number. The underlying number is still up a little over that. There's lots of argument you'll be hearing in the press about which is the real one. All we need to know is it's above the Reserve Bank's the Reserve Bank's target of 2 to 3%. That means their job is to get it back into target. Almost the only tool they have to do that is to increase interest rates. Now, one of the things they do when they're trying to get the effect without increasing it is to talk about increasing. So you'll see the RBA still on hold, but their language is very talking about they'll do whatever it needs to happen. They'll increase if they need to. And that means they're trying to scare the markets in the behavior that an interest rate rise would do. So think about what an interest rate rise does. It slows down our behavior. There's less money to spend. So sometimes just the fear of it going up is enough to do that. So they call that jawboning the market. Now, the Fed's done something similar. They've shifted to a neutral stance. They were looking at cuts. Now, clearly with inflation over there, also at about 4%, also above the 2 to 3% band, they've got to look like they're prepared to cut. We've got the new head of the Fed over there, Walsh, and he's keen to make sure the markets don't think he's a Trump puppet. Trump would like to see interest rates way lower, but that would cause market meltdown at the moment if he just came in and acted as a puppet. So he's talking tough. I don't think he really wants to increase rates. I don't think the RBA really wants to increase rates as well. It's already having an impact on a little bit around employment and a little bit around property prices. Not that they mind that, but employment is the other part of their mandate of keeping Australia at good levels of employment, which we are. Like I said, oil prices down. The big market news for the month was SpaceX listed. SpaceX is this combination of Elon Musk's business interests from his former Twitter, from SpaceX, which is the space travel, Starlink, which is for many of you, you know Starlink from your travels around the country where you use that for your internet access, and a few other things. And the market paid effectively a few $1 trillion for that business. So Musk, based on his shareholding in that, has become the world's first trillionaire. It's a phenomenal number. Now he's talking amazing things. The valuations are not something that most investors could invest in. It's trading at 95 times its current revenue. That's not even profit. That's 95 times revenue. It will have to grow a mile to make that worthwhile, but it just might. Musk has sold a story here of putting data centers on Mars and et cetera, et cetera. And if he nails it all, yes, maybe it'll be cheap, but it's very much a speculative investment. Everyone will get a bit of it through the index funds. So everyone will end up with some of it. The question is always, should you have more? And except for super speculative Musk fans, we certainly wouldn't advise being overweight in what is one of the most speculative investments that we've seen. Bond yields going lower. They're not quite to pre-war levels, but they're getting close. We'll have a look at those in the charts in a minute. And in Australia, we're post the budget. Budget dropped in May. We're now in June. And we're just seeing chaos. Lots of vested interest crying poor. It's going to ruin the startup industry. It takes away incentive. There's a little bit of truth in some of that and a little bit of just pushing vested interests. The government won't admit that they're trying to make property prices drop, but how else do you make property more affordable for young people? And that's been their mantra. All this was done to make it easier for young people to buy property, but it's clearly not the case. Part of what they're doing here is just implementing old Labor agendas under the cover of making properties affordable for young people. I'll touch more on the tax changes and the state of them towards the end of it when we're talking about property. But yeah, lots of deals, including one yesterday, which is where Greens and Labor have done a deal to stop gearing in self-managed super funds to buy residential property. And I'll talk about why this is just nonsense and it's not even policy on the run, because it's not even policy. Greens don't like anything aspirational. They think this is going to affect the top end of town, but it actually affects mum and dads trying to get ahead of the curve and build some wealth. It doesn't affect the multimillionaires and the billionaires. This affects aspirational and young people as well, who for some of them getting property through their super has been the only hope to own some property. I'll talk more about that in a minute. Property markets, the growth has softened. Melbourne and Sydney are down. Other states are up by less. So the growth is neutral last 3 months, about square. We'll talk about that. But you'll see headlines saying property slowed down. Once again, it's a slight manipulation of what has actually happened. The growth rate has slowed down. We were growing very strongly. The growth rate has stopped to zero, but that's not prices going down. Now, there's a million markets all around Australia for every suburb, for every price point. You've got the luxury properties and waterfront Sydney to the mum and dads of suburbia. They're very different markets, so there's lots of different stuff going in. Nothing usually among us on all the rates. Their mortgage rate's still about the same, into the sixes for pretty much everything we see. You can still get a decent one-year term deposit at 5.35, good for those with money. On the short term, who knows what that will be longer term. I dare say locking up your money in a one-year term deposit right now might mean when the money comes out in a year's time, you might only be seeing 4% or lower interest rates, is where we do see interest rates dropping after inflation is dealt with. There's a debate about how long that takes, but it's probably going to be sooner rather than you think, because inflation's the growth of prices. So for this month, as we see petrol prices dropping, all of a sudden that adds a negative growth to inflation number, so that helps lowers it. So that, when prices have gone up from oil, that pushes inflation up. When they go down, that pushes inflation down and might even make it deflationary. So we'll see what happens. Let's jump in. Portfolio returns, solid one-year returns, doing what markets should be doing. We'll round out the year as June finishes, but looking pretty good. Markets are up since the end of May, so we should finish another strong year. The last 6 months during that war time has been a volatile time. You'll see the 6-month returns are pretty low, as to be expected. 3 months, almost no return over 3 months. The last month has been a big jump, and that's looking like June again. But the longer term returns right within our range, and portfolios doing what we would expect them to do given what the markets have done. Our market view in terms of our money on the move dial stays at 9. So markets are a little bit expensive, not crazy expensive. They may not get any cheaper, but they may. There's a small chance of 10 to 15% corrections, but not much chance of major corrections. And I'll just exempt the Magnificent Seven, big end of town on that. What we're seeing is massively high valuations around tech stocks, particularly those big AI dominated tech stocks, and that may come back to earth at some stage. It's probably going to be like the .com bubble when it burst, that it had a big impact on US shares, not much impact on Australian shares. We don't have a big tech sector here. But the thing is, the AI boom is real. It's having a massive impact on profits. right now, the profits that these big companies are making are real and they're huge. So it's very different from the dot-com boom where there was no profits to be seen and prices rose on revenue multiples, a bit like SpaceX, but not on profit. So this may be the start of a boom. I hope it keeps having little corrections because that makes it more sustainable in the long run. Whatever I hope for has no impact on what might actually happen. The markets will do what markets do, and that is they will fluctuate. But yeah, AI is driving profit. It is driving growth amongst smaller companies. Well, you'll see that when I go through returns. So we're climbing through, and in our wall of worry, we've seen another valley of fear close, which was the Trump tariff tantrums, and we're just closing out now. The short-lived Iran war, we think. So that valley of fear will close and soon be consigned to history. Let's have a look at interest rates, and I'll focus on the right side of the chart here today. You can see rates in the US of 10-year rates. This is 10-year government bond rates. The reason these are so important is US 10-year bonds are just about the most risk-free asset in the world because there's two risks, there's layers of risk when it comes to bonds. One is you don't get paid your interest. The other is you don't get paid your capital. When the US government issues those, there's almost zero risk of default, never zero. And that's where you may see interest rates sometimes go up massively from cash rates where there's speculation. But the US is still considered the safest government debt in the world, pretty much. So that has dropped back from the peak of when the petrol prices were going up, that the war was there. So that's helping. In Australia, it took a while, but it's now started to drop as well. We're back under 5% after being over 5% for a while. So all of this is good news. That will flow through eventually, hopefully, into borrowing costs, although the cash rate is also driving that as well. But lower bond yields are good. We see, and when I say we, the investment committee has a view that somewhere past this temporary inflationary blip, and there's massive debate on how temporary it is, how transitory it is. You might remember that from during COVID, where we had inflation jump up to 7 to 9%, and there was talk about whether it was going to be permanent or transitory, whether it was going to breed stagflation. We're at much lower levels here. We look like we might get stuck in the 3 to 4% range. That is not catastrophic. It's not great. They don't want to let it get away, but also politically, certainly governments don't want to see higher interest rates. The Reserve Banks and the Federal Reserve and other monetary authorities will be trying to show their independence from politics, and we'll see how they go. But hopefully there's a bit of luck here, and interest and inflation comes down, partly just because of the negative, the oil prices going lower, other deflationary things. Generally, rapid technology advancements are deflationary because the tech that we use costs less. So we got deflationary forces and inflationary forces. We'll see how they land. But we have this view that on the other side of transitory inflation is probably a natural rate of 10-year bonds of about 3.5 to 4%. Now, that would prompt the Reserve Bank to be potentially having lower interest rates, and we might see a bit of mortgage relief, although there's still arguments whether the natural rate for mortgages is actually 6%, not 5%. For those of us that remember having mortgages in the 70s and 80s, we remember paying so much more than that. That's even 6 seemed incredibly low. But for those that borrowed in the post-COVID period, anywhere from 2 to 4%, 6% seems impossibly high. And that includes a lot of younger people with big mortgages. So they're doing it tough. That's a real thing. In my exciting life, boring money, and not the other way around segment, I want to talk more about private assets or unlisted assets. We're starting to see, we've been of the view for a few years, that there's been a build-up of money going into these assets, and that's led to a lack of quality, and we're going to see some trouble ahead. We're starting to see some of these bodies float to the surface, so to speak. This month we saw a private equity held company called Medallia, who was run by a private equity company called Thoma Bravo, is effectively gone broke. So what that's done, that's wiped out $5 billion that the investors within Thoma Bravo lose. So it's a pretty solid number. Now what they do is they'll borrow more money, and these private companies, they're not only private equity, where the private equity companies have taken shares in them, but often other lenders through private credit lend money to them. So these things are not clear on the market. You can't tell what the value of an unlisted company is. So it can go from call this one 10 billion or 5 billion down to zero without you seeing it day to day. So the people that own this, and ultimately the people that are paying this is the investors in Thoma Bravo, a private equity company. Many private equity companies are already also locking up redemptions and saying it's going to take a lot longer to work it out. So be careful about seduction by people talking about higher returns from private equity and private credit. They may be higher with their headline number, but the risk I'll talk about in a minute is an iceberg risk. It's harder to see, and you don't see it till it's nearly a wipeout. I've got another example there today, and I've left the brand in. Please don't Google this. Please do not invest money in this. These are symptoms of trouble ahead. There's an ad, I think this was on Google, 12% paid monthly and up to 12%. These people prey on people that are only getting 4 to 5% their term deposits, trying to make it sound like this is a term deposit type investment. When you click on the link, you get this: income generating investments, opportunity for investors seeking a high yield, earn 10 to 12% per annum with asset-backed security. But I warn out, one, this is only available to wholesale investors. So they're actually looking for wholesale. It's called in the legislation sophisticated investors, so people that have a net wealth of more than $2 million, which isn't hard these days, or income of more than 250,000, which also is not so hard these days. But particularly, you can have a novice or a naive investor who's got a house worth $3 million. They don't really understand risks, and these wolves in sheep clothing, as I call them, are out trying to get their money. Now, what do? They take that money and they lend it through their private credit operations to people, and they lend it at about a 5% margin. So think they're going to pay you 10 to 12%. So they're lending it to people that are going to pay 15 to 17%. Now, why would anyone borrow at that rate? And there's only one reason: it's because they can't get it from the bank at 7 to 8%, which would be normal, 6 to 8%, which would be normal business terms. So these are people that are much, much higher risk. But what the investors in these things don't realize is they've become a high risk lender, and there's a big chance of that, what I call that iceberg risk. And that iceberg risk is, it looks really good when you just look at the surface. Yeah, I'm getting 1% of my money. I'm getting 1% of my money. I'm getting 1% of money. Then there's a notice that the whole thing's gone broke and you've lost 100% of your money. So I love the honest risk of the share market, the property market, and the bond market, where you see the risk every day, and it's honest because there's a public market for it where you can sell your shares. If you want to panic and get out, or if you want to get out, you can sell it today. Same with your bonds, same with your property. You may take a loss, but you can get out. With these private equity and private credit investments, they're illiquid. You can't get out for years and years. Sometimes you may never get out if they fail completely. So they gloss over that, they hide that. And we are certainly worried that they're right at their peak at the moment. This is a natural reaction of what happens. 2007, massive crisis around the world in banking. The banking regulation was increased massively, and that meant banks could no longer engage in riskier lending. It took too much of their capital. So it created this market for private lenders who aren't as heavily regulated, or sometimes aren't regulated at all. And they've slowly filled the market. In the last 5 years, it's been exponential in growth. And whenever you have lots of money going into a market, whether it's property, shares, credit, which is lending, the deal quality starts to suffer. And eventually there's a reckoning to be had as things get to the crazy stage. So I just wanted to talk about that today. That iceberg risk applies to private or unlisted markets where you can't get an accurate reflection on what the price is. It applies to private equity, private credit, and all these things are where there's no secondary market. It means there's no official secondary market. Sometimes there is a secondary market for distressed buyers. There's some savvy long-term fund managers that make their money out of distressed credit, where they buy these things at a discount. They might buy the debt for 20 to 30 to 40 cents in the dollar. So the original lenders get back 30% of their money. So this is why this stuff is way higher risk than the share market, way higher risk than the property market, but it's never sold as that. So beware. The tailwinds, headwinds, I'll put them up. It's interesting. We started these as the year around. Some of them have come to be, which is the green for the tailwinds. We've got pretty good growth. We've got AI and CapEx super cycle going crazy and is driving growth. It's real money being spent that flows through the economy. The tailwind that hasn't come about is easing monetary policy. We haven't seen lower rates. In fact, they've gone up in Australia, steady in the US. We've seen continued strong government spending. We partly wish they wouldn't because it's not helping with inflation and government debt, but it certainly helps with growth. And then we've seen corporate balance sheets in pretty good shape for the most part, particularly, like we said, the listed ones in shares. And we're seeing emerging markets really benefit from a lot of things, including supply chain, but also the AI boom as well. I'll talk more about that when we look at their performance. The headwinds, certainly. Sticky inflation has been a headwind. The red ones are the ones that are confirmed here. Yes, they've come in as bad as we thought. Geopolitical noise around Iran. Yep, there's been plenty. Private credit and non-bank, I could have marked that as starting to show weaknesses and cracks. Ironically, even though the US and other governments around the world have incredibly high debt, that hasn't started any confidence-driven problems yet. And this may be something that plays out over 5, 10, 20, 30 years. As long as people are prepared to buy US government debt, the bonds, then this kicks down the road. And the potential black swans, we've seen some of those. They haven't been too bad. Central banks, certainly Australia, were forced into hikes. We've got some stress in the private credit and shadow banking area, and we've seen some geopolitical events. I highlighted as a potential positive one at the start of the year. Sorry, I noted at the start of the year, one of the potential black swans, it's not really a black swan, it's a white swan, is that there's no surprises and the upside we drive off. So in other words, if there's nothing really bad happening, then and the AI boom does start to show more and more profits, then we get a crazy boom. Keep in mind, we haven't had a crazy boom since 2004, 2005 through to 2007, 8. And the last one before that was pretty much the 80s, where we had the boom, then the bust. So we're well overdue. These things usually come along when most investors have forgotten the last one or they weren't around to experience that. And that's when we get the behavior, push-up markets. Once again, key strategies are just the investment, professional stuff, maintain diversification, avoid single themes, keep some powder dry always, make sure you're never fully committed so you've got opportunity and liquidity. You got money for opportunity and you've got liquidity, and long-term focus with short to mid-term awareness. And that's our thing. It's easy to say, yep, property is always a good long-term investment. Shares are always a good long-term investment. And it's absolutely true. But you need that short to mid-term awareness to not make mistakes, not do anything silly, and not get panicked out when they happen. So that awareness is critical. And that's why we have that assessment of where we're at in the markets. And at the moment, we're at that sort of fair to expensive. But that's not the FOMO, which defines the boom. We may well get to that. Not we may well get to it. We will get to it at some point. Once again, it's whether that's 6 months away or 6 years away or longer. But somewhere in that term, we'll probably have a crazy boom. Once again, the dial at 9. I won't pause there. I've highlighted to show in our mess it up the things that I've talked about today. Illiquidity is a dangerous thing. Now, even when you buy a house, it's illiquid, but you can sell it if you drop the price low enough. But with these private investments, sometimes they're just not saleable. And when we go through periods, we've had a short-term period the last 3 months where not much return. And if that lingers, as it will from time to time, people can start to look for these supposedly high performance investments. That can be a massive trap. So it's good to see performance coming back because that makes people less likely to do that, but they're still going to be looking. Once again, recency bias is just to focus on the bias that is where we overweight most recent news and we blame that for everything. In Australia, I've seen all sorts of articles that the new tax changes will change the way people invest. It'll cripple the property market. I don't think it does much of that. I think it undermines confidence, which does stall. I'll talk about property investing in a minute, but higher interest rates are one of the biggest enemies of property, and property prices going up, but also uncertainty. If people don't know what's going on, they just stop, they pause, they wait, and that's where we're at the moment. With that one. And in my 4 pillars of great strategy, and this one falls under investment behavior, and investor behavior is just us making good decisions, avoiding bad decisions. And the one I've highlighted this month is to talk about avoiding bad decisions. So we make more money by avoiding the bad decisions than we do by the good decisions. So the not trading, not speculating, not panicking, all these things. So avoiding the bad decisions is what makes us compound at the high levels that we would expect that enable us to live out good lives and get our plans there. So looking at the returns, so we've got, so in May, yeah, Aussie market up 1% for the year. It's about 7, last 3 years, about 10, about 8% over 5 years, 9% over 10 years. Pretty normal. We've got that in the Fed, a slightly expensive state. We got US shares negative for the month. They got all that back in the next month, by the way. So good long-term return developing, and particularly that top. We've coming through that hole. So you can see that hole, which was driven by the war, inflation going up, pushed up interest rates. That slowed down the growth stocks, which drive the US. We can see that filling up. Now, keep in mind, this is what is VTS? So this is us Aussies investing in US shares. And even though the US market's gone up by more than this in US dollars, because the Aussie dollar was also strong throughout that, we haven't gone up by as much. Global leaders, exactly the same story. You can see the chart there. Very good long-term returns. US small caps starting to look really strong. Now 19% for the year. I love diversification. So yeah, a year ago we had struggling returns from this sector, and now as the large cap turn, the small caps is taking its turn to carry the load and has provided really solid returns. And emerging markets even more so. 3 years ago, the 5-year return on emerging markets was about 4 or 5%. In the last month, it went up 10%. Kind of nuts. 37% for the year. This is a catch-up because it was cheap. We've upgraded our assessment on this from cheap to fair. But once again, 37% return in the last 12 months. So that makes up for a lot of the other bits and pieces, and is why diversification is so important, and why sticking to a plan is so important, because every sector has its day. Sometimes they take a while to come back. But a beautiful rebalancing helps us be buying more of that. And as this has gone up, we're now taking some profits and buying the other stuff. That's the rebalancing process, which means we try and keep things at a set percentage, which means if one sector goes down, so US shares gone down for us in this month, emerging markets went up. That means we're selling some emerging markets and buying some US shares, which adds value over the long run. Gold has had quite a year. 6 months ago, gold was showing 50% 1-year return. Still pretty solid for the year, but you'll see that come back. Part of that was hedge funds taking profit. Gold had run so hard. They took profit out of gold so they could play the oil trade, etc. As the war drops down, we should start to see gold acting as it should, as a good hedge against volatility in the world, and against inflation and against US dollar debasement. Let's have a look at property. Lots of noise around the property markets, particularly with the tax changes. On the left, I've got the headwinds and tailwinds as I define them at the start of the year. And I've had a postie note on the right to talk about what's happening right now. Interest rates are now higher. So that's caused some negativity. It's caused a slowdown in growth. It hasn't caused a collapse in the market, but it's just caused a slowdown in growth and a slowdown in sales. Interest rates high has a big impact on affordability, as I'll show you in a minute. Affordability just means it now costs, and I haven't got this in the charts, but I was reading something earlier today that showed, for the average person now needs $17,000 more a year to buy the median Brisbane house. That's a lot of money. That's $17,000 that they don't have for living, for buying other things and keeping the economy going. So affordability will have an impact, and is having an impact while interest rates are up where they are. Uncertainty causes people to just pause on their decisions and wait. All this arguing in the press and online, for those of you on social media, you'll see lots of memes, and depending on your political, which way you lean, they'll be exaggerated to give us what we want to hear. So anyone who's free market orientated tends to get right-wing analysis. Anyone who's socially aware, shall we say, tends to get left-wing analysis. And none of us get the truth, if you can even define a truth in the world and that sort of stuff. But it's uncertainty. And that makes it harder. And I'll touch on some of the changes and where they're at. But this last one I mean, overseas, it's always fascinating when you're not on the ground, but just reading the news. This is just the government just did a deal with the Greens. They're desperate to get this legislation through. The Greens have had this on their shopping list forever to stop people um, using their super to buy residential property. And yeah, as this great article has shown by Michael Yardney, the reasons this won't help a single first buyer. One, let me just go through the takeaways. Super funds can no longer borrow to buy residential property. For those of you that have them, I certainly have them in my super fund. We get grandfather. We don't have to get rid of them. But going forward, they can't be. Now, that's for residential. You can buy commercial property, which is good for business owners buying premises and those types of things. It's purely on the residential property by this fallacy that somehow investors compete with first home buyers. And of course they do, but it's not that it makes a significant difference. So current investors grandfathered. The impact on affordability is likely to be minimal. SMS borrowers account for less than 1% of residential property lending. And that's just of the lending. So it's not of the property market. That's 1% of the lending. So it's a very small part. And here's the deal. It affects mum and dad investors, not the big end of town. We've used this strategy for many divorcees, many women who are divorcees in their 50s or 60s, where they've lost a house through a divorce split. They're starting again. They can't afford a house. And one of the options they have was to use their super to buy a property, to use their super to pay it off, so that when they finish work and they're retired, they've got the option of taking the property out of their super, or at least having enough money to afford a property. So we've used this strategy, not widely, but certainly for people that are stuck, but they can't get in. Their supers are not growing quick enough, so they use this to buy property that they may move into down the track. It's a complex strategy. I was about to say you shouldn't do it, but guess what? You can't do it anymore now. So it's affecting, you're going to see headlines about this. It affects divorced women. It affects young investors who've decided they're not going to buy a residential property because they can't afford where they want to live. So they rent vest, and they've been able to do that in their super fund, but they can't do that anymore. So, and what it really wreaks havoc here with it's just policy certainty. So, we had a budget that didn't touch super and self-managed super funds, and all of a sudden, bang, they've done this deal with the Greens, and it just makes us doubt what's next, what's happening next. But it makes everyone less confident in superannuation rules and tax rules in general. Now, I'm not trying to cover every tax change. You'll see on the right in really small print all the changes from the budget and tax and where they're up to. Now, where you don't see blue's where legislation has been introduced to Parliament. All the rest, it has not. And I'll show you an example of the ones that are important to us. But over here, the big one is tax reform. And I love the way they've called this. Is from the tax office's website, and this is from the government budget. Tax reform boosting home ownership. Now, this does not boost home ownership. They've reformed negative gearing capital gains tax. Nearly every credible expert says this will have very little impact on home ownership. This is Labor wanting to tax wealth more than it taxes labor. It's purely that. Now, you could argue that's not a bad thing. I don't argue that, but you could argue that. But it's the fact that they dress it up with the latest hot topic, which is home affordability. And I think young people in Australia are waking up to this, that it's not actually going to help them at all. In fact, it stops them being able to do things that are smart for their wealth building. So the negative gearing legislation is in. Its proposed start date is 1st of July 27, so it's still a year away. The one that hasn't come in yet is the tax reform around minimum tax on discretionary trust. And this has got all sorts of nasties in it, but it wasn't due to come in until 1st of July 28. But it's just up in the air. Whether this ever gets legislated remains to be seen, or how it's legislated remains to be seen. The tax lawyers that we work with on a regular basis are advising to be very careful about any restructuring at the moment. So we're pretty all over this. So if you've got any doubts about your structures or where they're going, feel free to pick up the phone and talk to us. We'll be running some information sessions, but I will point out we're flying blind at the moment. We're going off announcements that may be changed. We've already seen changes to what was announced in the budget to both the capital gains and negative gearing, slight changes to do deals to get that through. And they've rushed this through without effective consultation. The government's clearly having here that with a few years left before an election, they can squeeze it through and people will forget about it. Only time will tell. I've got to say the opposition hasn't prosecuted a very good case against this. They're not being very competent on arguing this. Unfortunately, it has meant more disillusioned voters switching to more extreme parties, whether that's the Greens on the left or One Nation on the right. So we may be doomed to some weird coalitions like they have in lots of other parts of the world, Europe, New Zealand, where they've had mixtures of parties forming government. Time will tell. Maybe it'll swing back before the next election. We will see. Maybe that's what we need. Who knows? But we will see. So here's what's happened. So this is the rolling growth rate over 12 months. So rolling, you see the big boom after COVID where growth rates pushed up to 20, 30%, slowed down again. This is growth rates. So it's only negative if it's below the zero. And you see at the moment, none of it's below zero, but it's slowed down. And this is 12 months rolling. You'll see when I go to the next slide, we've actually got, this is 3 months rolling. And you see Melbourne and Sydney have gone back about 2% in the last 3 months. And some people will absolutely blame that on tax stuff. I'm not sure you can be that direct, but it's certainly the uncertainty around this has an impact. Now, the markets in Brisbane, Adelaide, Perth, Hobart have been so strong that they're still showing growth. Now, it's less growth than they were, because when I go back, we were sitting at about 10 to 20% growth in some of those areas. None of that's ever sustainable. We know markets, property markets don't grow that hard for that long. Long-term averages are 4 to 6%. So we know whenever we're that high, we've probably got to come back to earth. But that's kind of the state of play. No real change on interest rates. They're pretty settled this month. And we've got some movements around here. On the left, I have our performance property clock, which I love. They've changed slightly. No change to the clock, but they've just redefined how they call things here with the value on the momentum. And by the way, this is when you're buying to invest or you decided to sell, that this is useful. If you're just holding, it doesn't matter. Yes, there's a selling window. It doesn't mean you should sell your property because guess what? It does another cycle and it goes up during that cycle. Now, the next cycle might take 20 years. It might take 10. It might take 30. We won't know till it's done another cycle. So a good example of that is certainly Brisbane, Sunshine Coast, Gold Coast, so Southeast Queensland has had a phenomenal run the last 5 years. We've seen that for those of us that live here. And we've seen, doubling, tripling, on some areas. So it's now in what would appear to be a selling window, but only if you need to sell or you're planning to sell. Whenever we have that momentum, there's often a correction period, which we've seen. We just saw that Sydney and Melbourne. Prices do go down. Generally in Australia, it's very rare for prices to go down by more than 5 or 10%. They just pause, they slow down. There has been pockets of drops bigger than that, not in Sydney, Melbourne, Brisbane, but certainly in areas like Noosa, where we work from. Certainly, we saw the top end of Noosa post GFC drop about 40%, but that was tourism property, which carries more risk. But generally, that's the correction, and there's plenty in the value area. Melbourne, it's about half the price of Sydney these days. That's almost never happened. So assuming, if you make an assumption that Melbourne will eventually clean up its economy, which everything cycles, we've been here before in the 80s. It was then cleaned up by Jeff Kennett and everything went through the roof. We'll see if that happens, or not so much if it happens, but when it happens, and Melbourne looks like incredibly cheap at the moment, so it's good value. Doesn't tell you it's going to go up because there's still things that have to be fixed. In a perfect world, if you're trying to buy and make some money over 5 years, you're buying in the momentum stage and selling in the selling window. If you're medium term, trying to focus on profit, none of that's ever a guarantee, but I love these charts for doing that. Now we've got a chart from Harrington White, which is the commercial markets. Just thought we'd show something different. And you'll see there's lots going up in the commercial markets, lots of rural stuff in particular. Sydney peak market. Melbourne start a recovery, others still, and you see there the Sunny Coast, for instance, is still going up, but not necessarily at peak. Not that anyone, including these guys, know where peaks are. So this is a chart from Performance Property that looks at affordability, and it's an index. So in the blue bars, we've got property affordability. So high bars are probably less affordable, low bars are probably more affordable. So we had the most affordable property in the last 30 years occur off the back of COVID. What was the feature there? Interest rates were 1 to 2%. Of course, properties were affordable at that point. Fixed rates, I know plenty of people, I think I did as well, fixed some rates on some properties around 2, certainly 3%, massive affordability. Now rates have gone up. You see that's on the, in the current phase, affordability is, it's got harder. So the blue bars have got higher here, but prices have not changed. So we're seeing a gap there between affordability, and we may very well see that stagnate if people can't afford to buy. And this affects the bottom end more than the top end, because at the top end you get people selling one property to buy another one, but at the entry level, it's people with new money. The banks will only lend enough to a young person or couple that chews up maybe 30 to 35% of their income. So if all of a sudden interest rates are up, it just means there's less they can borrow. It's as simple as that. So that controls prices. One of the dirty little secrets of property that no one ever talks about is the biggest reason property went up over the last 40 years was interest rates dropped from 17% down to 2%. Now that meant banks would lend people more money, which pushed up prices. That is the single biggest reason. Then you have supply issues, supply and demand issues on top of interest issues. This just shows the city median property index versus regional, and over that time, cities have outdriven that. Regional has caught up in recent times, although the gap is widening again. But $1 million for a house in the city, that's the average all around Australia. Obviously, Sydney's closer to 2, and some are less than that. But even regional properties, the median value is now approaching 800,000. So that hill change, that sea change is not necessarily as big a difference as it used to be. So in wrapping up, hopefully that's been helpful. As always, please feel free to send us any feedback about things you'd like to see. Please feel free to share this with friends or anyone who you think might benefit. But just reinforcing a process. All investing best done as part of a real plan. And a plan has goals based on what's important to you. Portfolio then designed to meet those goals. We do take a long-term view, but with that short to medium-term awareness to help keep you on track. And then the boring stuff that we know works really, really well. Diversification, asset allocation, liquidity, rebalancing, low-cost index for most growth markets, and protecting its short-term volatility with the reserves and the dollar cost averaging is the main way we do that, and a bit of short-term awareness around the active portfolio. We rebalance regularly. Only 3 ways to lose money, and congratulations, we still have a wonderful bunch of clients that don't do this with our help and guidance. And those 3 ways are panic and selling, having to sell, and not properly diversified. When you invest well, you have confidence in your investments, that gives you the basics, the confidence to not look at this stuff, to not be worried too much. And it's certainly not a time to be worried. So until then, I wish you an exciting life and relatively boring money until we speak again next month. Until next time, Rob McGregor signing out.